Hi, I'm Max Keiser.
I'm Stacy Herbert.
This is the Keiser Report. Today, Stacy, we're going to be talking a lot about risk in all of its forms. Tell us. I'll fill you in as I go along. But tell the people what you got over there.
Okay, well, let's start with the first headline, Max, because that has risk in the actual headline. T-bills no longer considered risk-free by Chicago Mercantile Exchange. CME Group announced Monday that as part of a normal review of market volatility, they claim, it is determined that T-bills should no longer be treated as risk-free when used as collateral. Haircuts on T-bills will rise from 0.0% to 0.5%.
That's right. Let's talk about this for a moment. Treasury bills, you see, when you have them in your portfolio and you use them as collateral, you can borrow against them 100 cents on the dollar. And this is interesting because if you remember going back to the construction of collateralized mortgage obligations, what they did was they created collateralized mortgage obligations as a way to skirt the margin requirements as set up by Basel in Switzerland. That's the genesis of collateralized mortgage obligation because it's all about the margin requirements. And margin requirements are different for different classes of assets. So a junk bond, you have to put up more of the junk bond if you want to put it into an account and borrow against it, the margin account as it's called. Treasury bills, you can borrow 100 cents on the dollar. T-bills, you can borrow 100 cents on the dollar. But what they're saying here is that they're so worried about the underlying fundamental integrity of these global markets that not even a treasury bill is as good, 100 cents on the dollar. They're going to require you to post more of these bills into these margin accounts because, quite frankly, these global economies are at the risk of this precipitous collapse caused by over-indebtedness. And the CME, it almost sounds as if they're doing something responsible. But that can't possibly be true because they've done nothing but conduct themselves irresponsibly for years. But let's see what else is on this subject here.
Well, there's another headline regarding this, and they are saying that CME acts to curb volatile Treasury futures. And they're saying in this article that the reason why the CME is raising margin requirements on Treasury bills is that they've been so volatile as the kabuki theater between Boehner and Obama has been going on about whether or not they're going to raise the debt ceiling and whether or not they'll allow the U.S. to default. So they're saying that it was the volatility and that because of that volatility, it was driving people away from the markets, so the Chicago Mercantile Exchange was not making as much money.
Well, volatility is a function of leverage or margin. And by increasing the amount of treasury bills you have to put into that margin account before you can borrow oodles and oodles against it, you are supposedly decreasing the volatility, and they're hoping by decreasing the volatility they're going to increase their order flow. But, the point about, the main point about this, Stacy Herbert, is that what the CME is not mentioning and what people tend to forget is that on an exchange like the New York Stock Exchange, 70% of the volume is computers trading with computers. And they do this. People think that prices are the result of supply and demand and that a lot of people want something, so the price goes up. And it happens as the result at the tail end of a transaction. You end up with a price based on the buyers and the sellers. But that's not true anymore. You have traders on Wall Street like a Goldman or JP Morgan. First, they figure out the price they want ahead of time. They create the algorithm. They release the algorithm onto the floor of the exchanges, and then the algorithms take prices to the predetermined levels that were set ahead of time, ahead of the trade. And to do this, you need overwhelming computer power, and as I said, 70% of the trades are done by computers, to create prices that are predetermined, and that, of course, is the very definition of insider trading and market manipulation.
Well, the CME was in the news recently on our show when we talked about them hiking margin requirements on silver, and this was just before the 25% correction in the price of silver in May. Now, silver is in the next headline, Max, speaking of this volatility in CME. Silver may rebound to test $100 level, Citigroup says, technical analysis. Silver may more than double to $100 an ounce if the current bull market follows similar patterns seen between 1971 and 1980, according to technical analysis by Citigroup Global Markets Incorporated. Now, I want to show you this chart here, Max, and this is provided by Ned Naylor Leland. And as you see, the red circle there, that's where we were just at April and before the 25% correction. As you see, it's very similar to what happened in the 1979 run-up, 1,000% run-up from its secular low. And then it took a 25% breather. And then, as you see, it zoomed ahead to all-time highs at that point.
Well, this is where, ideologically speaking, we see that the CME is caught with their pants down. Because if they were truly concerned about volatility, they would let the natural order flow and price discovery occur in the precious metals markets, including silver. And you'd have a lot of that capital flowing out of speculative bets, flowing out of the margin accounts and buying into precious metals. And this would recalibrate or rebalance the system and reduce overall volatility. But the fact that they actually monkeyed around with the margin requirements on silver selectively, instead of other commodities or other financial futures, they targeted silver to increase volatility. The entire drop back a couple of months ago, when it was at 50, then it moved down to 33, that was engineered by the CME. The CME created that volatility as a way to scare people out of silver because they're in bed with the paper bugs. So this is the fight between paper and metal.
Yes, and as we pointed out at the time, even Bill Gross, who operates the largest bond fund in the world, a paper bug, he mentioned exactly that the CME had done that intentionally to drive the price of silver down.
That's right, and all it has done is it's radicalized more silver buyers, like the Silver Liberation Army, for example. They're simply buying more physical silver, so the base upon which this rally is being built is widening, and if you get a wider base, the ultimate price target extends to a higher objective.
And so another headline regarding commodities exchanging on various exchanges around the world that has been overlooked during this diversion of this fake battle over the debt ceiling. Totally fake battle changes nothing in the genuine economy of America or the world. Another Citi headline, Citi's top economist says the water market will soon eclipse oil. So this is Willem Boyder. And he says that he expects to see a globally integrated market for fresh water within 25 to 30 years. Once the spot markets for water are integrated, futures markets and other derivative water-based financial instruments, puts, calls, swaps, both exchange-traded and OTC will follow. There you go, Max, derivatives for fresh water.
Yeah, this is a remarkable story for a lot of reasons, because the problem is that the amount of fresh water in the world is diminishing. You know, of all the water in the world, less than 3% of it is fresh water, and most of that is frozen. So what the planners, the central planners in countries like America are planning to do is to create derivatives based on water. They believe that increasing the liquidity of paper derivatives somehow increases the availability and liquidity of fresh water. Now, nothing could be further from the truth. We know that when you introduce derivatives into a market, it causes price dislocation, shortages, and market failure. We've seen that in food markets around the world. That's why you've got famine, because price of food is skyrocketing thanks to abuse of these markets.
What we've seen with derivatives markets, Max, is anytime they introduce a collateralized debt obligation backed by these mortgages, what happens? Everybody loses that asset, and the banks gain it through these derivatives. Greece, the credit default swaps on their country. What happens to the country once these derivatives are introduced to protect them from the risk of that? They lose their whole entire sovereignty and nation. So look at where's the biggest body of fresh water in the world? It's in Russia. It's Lake Baikal. So, you know, anybody with freshwater assets now should be very concerned about these derivatives, because they are used as a technique for seizing that asset in a way that they say the markets decided that we should own all your assets.
Well, it'll raise the cost of water. Ultimately, that's the bottom line. It'll raise the cost of water and cause a lot of people to dehydrate and die. And same thing with food, and same thing with these other markets. And credit availability is too expensive. No one can have access to credit anymore. It's too expensive. So there is no credit available. So you have this de-globalization taking place now in the world. We've hit peak credit, peak oil, peak water, peak gold, peak silver, peak everything, because the industrial model of the past 100 years played itself out. Earth carrying capacity can only support so much, and that got eclipsed in 2007, and now we're on the down slope.
Yeah, and it's the financialization gone amok of our entire global economy, and that's not been addressed at all, not for one single day, during all of these so-called debt ceiling debates and all of the 2 years of pretend drama between the red team and the blue team in America. Nothing's ever been addressed about the financial system and the financialization of our economy.
Well, I mean, that's why we're going back to the Dark Ages and the Middle Ages and the Crusades. I mean, you see this all the time now in countries all over the world. It's gone back to religious wars because neoliberal economics has failed, neoclassical economics has failed. Now we're going back to the economics of the Middle Ages.
My final headline here, Max. The help wanted sign comes with a frustrating asterisk. So apparently the unemployed need not apply. If you look at job ads across America, they're saying that they don't want basically unemployed people. You have to be employed if you're looking at this. And the other way they're excluding the unemployed from the jobs market is that you can't have a bad credit rating for many jobs in America. So, of course, people have been unemployed for 18 months, 24 months, and they start to accumulate negative points on their credit score. So they get, literally, they're banned from applying for many jobs.
Well, I mean, Joseph Heller wrote that classic World War II book, Catch-22, about the insanity of war. This is being applied now to the job market. You know, you cannot get a job unless you have a job. How do you get a job? Well, you need a job. And it goes around and around in this vicious cycle because basically companies don't want to hire because they don't want to spend the money because all of their profits come from trading derivatives. The banking sector has gobbled up 50, 60, 70% of the economy, and you're trading electronic phantom paper with each other to create phantom profits, to create phantom printing excesses down at your friendly neighborhood Treasury and Federal Reserve Bank. But you don't want to hire real people. You don't want to pay them any kind of a real salary. You'd rather keep that money yourself. Again, it's back to the Middle Ages of lords and serfs. And, you know, in America, 330 million people, you've got 329 million peasants. Stacy Herbert, thanks for being on the Keiser Report.
Thank you, Max, and thank you.
Don't go away. Stay there. Much more coming your way.
This history still keeps its secrets, but now it's time to reveal the hidden. The Soviet Files on RT.
More news today. Violence has once again flared up.
These are the images the world has been seeing from the streets of Canada.
Giant corporations rule the day.
Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to upstate New York, someplace called Saratoga, and talk with James Howard Kunstler, author of several books, including The Long Emergency and World Made by Hand. James Howard Kunstler, welcome back to the Keiser Report.
Hi, Max. Nice to see you.
All righty, James, according to your most recent blog post, you have dumped some of your Treasury bills. I sense there's a story here. Tell us about it.
Well, I just got kind of nervous about, it wasn't the idea that they were going to lose value overnight or that I was going to be stuck with worthless paper necessarily. I was getting a little concerned that the banking system was maybe going to freeze up and that we would just see a lot of sort of problems and obstructions in banking.
Right. So this is interesting because a Treasury bill is considered to be really indestructible in terms of its creditworthiness. It's the basis upon which the entire U.S. economy is built. It's the basis upon which the entire global economy is built if you consider the fact that the U.S. dollar is the world reserve currency. So the fundamental building block of the global economy, the lowly U.S. Treasury bill, you're suggesting that it is not as creditworthy as some suggest. So my question is, with all this talk about the AAA rating of U.S. debt being downgraded, it sounds as though it's already been downgraded in the minds of a lot of people, yourself included.
Oh, yeah. I think the psychological effect of what's already gone on is really strong. And I can always go back to short-term Treasury bills if I have to, and I'm going to bail out for a while into other short-term instruments and wait it out, sort of like, waiting out a contagion.
Let's talk about the craziness that's going on in the U.S. concerning the debt ceiling. Up until a few months ago, people didn't focus on this debt ceiling so much because every time it came up for expansion, it was automatically expanded. There wasn't a huge issue. Suddenly, they're attaching all kinds of riders to this, that there has to be a re-examination of the entire fiscal policies of the United States. How did that happen? Who are the players, and what's really going on?
Well, I think what's really going on is that all of these machinations, and indeed a lot of the trouble all around the world, really comes out of from one source, which I think is the growing scarcity of capital. And, any way you cut it, we're having problems allocating money to the places that are used to getting it, and it's a game of musical chairs. And, someone is always coming up short, and every week it's a new musical chair player, and every week we have to sort of find some way to make up for the fact that that money's not there, and we're going around and around, and that game really can't go on that long. There are some people, including myself, who attribute a lot of this trouble really to the peak resource and peak energy resource issue fundamentally. And that, when you have fewer energy inputs and resource inputs available for your economy, you're going to eventually that will be expressed in having less capital available. And so you see the whole world scrambling for capital in a situation where capital is increasingly scarce. And it's reflected in currency problems and banking problems and the management of capital itself.
Yes, you talk about scarcity of capital, and this is something that people can't wrap their minds around because they have grown used to the idea that capital can simply be loaned into existence in the current fractional reserve system where there are no checks and balances. It's just a matter of clicking a button, and there you have it, a new $1 trillion in capital being created. But you bring up an interesting point here in that the reason for this capital to be loaned into existence for decades has been to finance and to underwrite the global energy business, which is probably, if not the biggest business in the world, certainly close to being the biggest business in the world globally. And now that you have these resource constraints, and I just read somewhere that something like 56 countries, oil-producing countries, are now in decline. So you can make the case that the entire globe is in decline in terms of output of oil. You also have this phenomenon of shrinking capital. So are these two coterminous? Are they tied at the hip? When you hit peak oil, as it's called, do you also hit peak capital? Are they connected? Can you explain that a little bit?
I think it's self-evident that they're connected. And, you know, what we're seeing are very large chains of consequence and feedback loops of systems that are tied together. The energy system, you know, represents the primary resource for an industrial economy, and it allows the other systems that we depend on to work, including our systems for doing commerce, our systems for doing agriculture. And remember, one of the main inputs for agriculture now, for the form of industrial agriculture that we practice, is capital. You know, that comes right after all the diesel fuel and the oil-based pesticides and gas-based fertilizers. You know, capital is what keeps our food supply going, and that's becoming scarce for farmers all over the world. Our transportation system and the banking system, which is the management of capital, the management of accumulated wealth that can be allocated for productive purposes. Unfortunately, our wealth for the last 20 years has been allocated for financialization, which is really, as we know, paper shuffling and not productive. And that's been able to go on for a period of time because, you know, there was tremendous momentum built up in the fossil fuel-based industrial economy.
Yeah, I was talking to Stacy Herbert in the beginning of the first half of the show, and we were talking about the diminishing resource of fresh water. And going forward, as fresh water becomes a diminishing resource, the happy talk coming out of Washington would be, well, we're just introduce huge industrial strength desalination projects. But of course, that would require capital. So you can't have liquidity in the capital in the water market without liquidity in the capital markets. So therefore, would you agree with that?
Well, yeah. I think a better illustration in the USA these days is the shale gas scam that's going on. There's understandably a great wish that America could produce enough energy to keep the things that we run running virtually indefinitely. You know, we're so invested in the stuff that we got, including our suburban lifestyles and the interstate highway system and all the other things that we do, that we want to imagine that we can keep on doing this forever. So the story has been going around for about the last year that there's 100 years of shale gas out there. And the shale gas play or bonanza got ramped up around 2004, 2005. And it started in Texas, around Dallas, Fort Worth, with the Barnett play. And, you know, it seemed like a magical thing that we had these new techniques for drilling, and you could go down horizontally and shoot a bunch of water in there and break up some tight rock, as they call it, and you'd have a manufacturing process rather than a drilling process for gas. It would just more or less continually, reliably come out at a great rate. And what happened was they discovered that in this form of gas drilling, that after the initial production, the flows fell off very dramatically, up to 85% in the first year. And they used the initial production figures to raise tremendous amounts of cash and to get to sell shares and to get borrowed money. You know, most of these companies were running at 200 to 400% of their costs for doing what they do. Anyway, they sort of front-loaded the shale gas plays with high expectations, and they played upon the American public's wish that we would have endless energy. And when the Barnett play started to show a great deal of weakness very quickly, and is now virtually over. And when that came to an end, they moved on to the Fayetteville and Haynesville in Louisiana and Arkansas, and those are now showing weaknesses. Among the weaknesses are that the geographical area of these shale gas plays tends to retract to a tiny fraction of what they originally thought, to these things they call sweet spots. So now they're up in New York and Pennsylvania, and there's a moratorium in New York, which there's a lot of agitation to lift it. There's a lot of fear about the fracking process, where you shoot all this water down into the rock to fracture it and liberate the gas from the tight rock. So that hasn't been settled. But I think the bottom line is we're going to discover that the shale gas industry is not a manufacturing industry. It's basically it's a real estate play. It's a way of obtaining leases and then selling them off for 5 times the amount of money you paid them for. Ultimately, we would have to throw an immense amount of money and steel, that is capital and steel, at this process to keep it going at anything like the rate that people wished for. And so the 100-year supply of shale gas is actually looking more like a 6 or 7 year supply of shale gas. And that would be added to the conventional gas. So we've got about 20-odd years of gas altogether that we can pretty much depend on. But that's about it, 20 years.
So we've already hit peak fracking.
Well, we've certainly hit peak fracking in Barnett, and we're getting there in Louisiana and Arkansas, and we'll get there soon enough in the Marcellus. But it's unfortunately it's a dodge. It's just another thing that allows Americans to not pay attention to the changes that we have to make in the way we live. And, I'm not suggesting that we have to become socialists or communists, or we all have to move into, one big house together. But what it does mean is that we're going to have to pretty severely reorganize the things that we do in American life, the way we do transportation, the way we do farming, the way we inhabit the landscape, et cetera. And we're not prepared to think about this at all.
Right. Well, it sounds as though without capital, you can't have capitalism. And with all this theocratic kind of middle-age type crusades going on, it seems like we're reverting back to the dark ages politically and economically, because we simply don't have the capital to support capitalism anymore. But anyway, James Howard Kunstler, that's all the time for we have. Thanks so much for being once again on the Keiser Report.
You're welcome. Nice to be here.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. And I want to thank my guest, James Howard Kunstler. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.